Good afternoon. This Tuesday, December 30th. Well, this will be the last video in the series that we do throughout the year, every Tuesday and Thursday. It's the best medium I can use to come to you and show you firsthand what my thoughts are rather than trying to use the printed word. So I hope you enjoy these. I know a lot of people comment that they do. So we'll continue doing these into the new year. Well, the grain trade going out, just pretty much bah humbug after our Santa Claus Rally. The market turned cold Friday, pretty much giving up the Santa Claus Rally to the most part for wheat and corn. Soybeans literally within pennies of their low after having seen that bounce. So what is happening? Is it that bearish, the news out there for South America? Not necessarily. What we're missing in all these equations is that the USDA is failing to adjust carryouts for Brazil, with China moving a lot of that business from last fall into the Brazilian marketplace, and their carryout is tightening up. And everybody's talking about the big crop that's coming in from Brazil. And that is likely. They're going to start harvesting here soon, Mardi Gras. So they think they're going to be almost half done when we get towards the end of January. But it's Argentina that's the finish of the South American crop, and they are now going into a very important productive stage, especially over the last several weeks. And I want to show you something that nobody really is talking about. They're saying, oh, it's going to be fine. Yes, it has been dry in Argentina for several weeks. The good news is the temps have only been in the 80s, and so they're waiting for the moisture, which isn't coming. It's not to come here for a few weeks, and actually, it's the 13 to 15-day forecast that throws hope that some showers are coming. But is the heat going to reduce? Well, we don't know that. And so the Argentine crop is going to get under risk in January. And that is typically why we get these seasonal tendencies in these grains. When beans rally into Thanksgiving, peak in the beginning of December, we've talked about this in the past, they drop into the holidays, into Christmas, and then somehow, some way, even like last year, we get this turn in the marketplace, and somehow there's a rally into January. Where does this come from? Well, a lot of the times it comes from Argentine crop problems when that weather gets El Nino-ish, so to speak, down there. Then, of course, we have our January final crop production number, which this year it's Monday, January 12th. And I'm of the thoughts that we're going to see corn and soybean yields lower than this. The question is, what other games are they going to play? I've heard they're going to try to increase corn acreage for the grain side by 600,000 acres because they think that much less was chopped. And so that's how they can kind of play with yields and keep total production up. So that carryout doesn't drop too far below 2 billion bushels, which, by the way, they did get it down there in the November 14th crop report. So let's take a look at something that'll probably raise some eyebrows when we get to Friday and possibly into next week. So here's an artificial intelligence redone collectively of the Euro, which puts together these anomalies that are coming together. And this is the heat that is anticipated. This is through Tuesday, January 6th through next week. Notice Uruguay in the 100-degree temperature. If you go down to the spectrum down here, 40 degrees Celsius, when you're in that 34 to 36 degrees Celsius, that's 93 to 96. And that's not fun stuff. And that's pretty much what's filling in the bottom of Brazil, where the southern areas of Brazil are trying to finish out. And then we have, which is like Rio Grande do Sul. And so now we have over here Santa Fe, Cordoba, down into Buenos Aires. Look at the heat down in here. It is going to be warm. And so this 1 to 10 days is going to be extremely hot and dry areas of Brazil and in northern Argentina. Now, when we break this out, take it to January 13th, we put it into the 360-hour trade going in here. We do see this spectrum. Here is Argentina. Look at this. That is warm. Look at the spectrum down here. It's going to be definitely into the 90s as it turns to the end of the window for January 13th, Tuesday. There is consideration that this front is going to stay warm. This will get interesting. Now, here's your moisture. I didn't realize how blurry this would come when I put them side by side. Through January 8th, there is not much to develop in the growing areas of Argentina. Over here is near the mountains. Keep that in mind. And so this here is almost void of moisture. And then we take it out through the 13th. This is the moisture they're talking about. They are hopeful that they're going to get some of this rain, coming in a little deeper. Well, if that is not there when we come back Friday and certainly next Monday, this is where the rally is going to come from in the areas of Argentina. Here's a different zoom on that. Here is through January, Friday the 9th, nothing, okay? Buenos Aires, Santa Fe, Cordoba. And so these areas are where the beans are growing. Nothing there through January the 9th. And now here is where they think through the 9th through the 14th of January, they think Buenos Aires gets a drink. It's not a lot of rain there. They're going to need some here up to 1.5 1.25 inches, but that is sandier soil. This is not the soil of Iowa. Keep this in mind. They need rain. They need a lot of rain. They need it all the time. And here they get a drink up in Santa Fe. These need to stay in this forecast, because if they don't with that heat and this starts getting diminished away and they start blocking it out similar to this one, well, then that's not going to be good. And soybeans will be on the trek back to the upside, which is why we threw some cheap in-the-money calls that'll expire on January 23rd. We're in the money right now. We only gave them about 8-9 cents premium. Most of them we got bought today, 22 to 23 cents on those 10.50 February bean calls. They trade against the March contract, and it'll get us not only through the next week, but to the January 12th crop report. And we'll see what the USDA has to say on that. If you're seeing value in getting videos like this, I suggest you get a free trial to our newsletter. Morning text alerts go out every day. During the day, if there's something important, you're going to get another text alert on the phone or a trade alert. And then we have afternoon videos such as this, or daily updates in regards to what's happening out there is a news affair. So either click the link below this video, scan the QR code, or you can go to our website, heartlandinvest.com. Our phone numbers are there. You can subscribe at the website, or you can call us, 701-222-0221. Give it a try. So as we go to the bean chart, on continuation, this is the March contract. January came down, slipped into the 200-day moving average and just past 618. March contract came on that very next day right here. And now we're coming back down to check out the 200-day moving average and the 62% retracement of this decline. This is why in the weekend hedger, I talked about how this 56 to 61 area is very important to see if we can get some solid support. I think the January got down to 51 when it made its low here as it came on the continuation. So looking for a first of the month low, which is Friday. Beans are notorious for first of the month. Here's a first of the month. Ooh, that lines right up with that. Here is first of the month, lines up with this. Amazing. First of the month here, lines up with this. Beans are crazy for first of the month. So we'll see. Wednesday, Friday, we get a low in here somehow. We stepped in probably a little early on the bean call because we didn't want to miss out. You know, you got to sometimes buy early because if you don't, you're chasing. And I didn't want to get into that kind of a situation, especially coming back on the 2nd of January. But for now, things look like there's potential for the movement. On soybean oil, we're waiting something from the EPA. Note that this low, when that occurred that day, and this one, none of them closed below the initial low I had targeted as wave 2. So this is a 1. Here is an ABC nasty 2. And we could be starting a 3 up here. Maybe it's tied to the Argentine weather, because remember, they're about soybean oil is what they are. They like to produce. And this could be the EPA. The soybean meal, this was the January contract. March came on the next day. We're coming back down to check it out. But again, 300 has become something important here in the soybean meal category for March. Looking for a turn back higher on these soybean meal contracts as well. Corn, well, you just can't argue with what is nothing land. And this is nothing land, okay? False breakout last week. We had to close above 550. Market didn't want to do anything about it the next day. Went in to try to sell a corn contract out, missed by $0.015. Should have just went to the market with our spec trade, took an out $1,000, and we could have reloaded down here. Wouldn't that be great? So the reality is we are doing a series of 1-2, 1-2s again. Soybeans looked a lot like this. Remember in our November video, how before they took off, or I should say the October video, we were looking for the same thing. And then finally we bolted through and got our movements higher. And this is what we're anticipating here. And this could be tied to the January 12th crop report that really gets us going. Next week could be, maybe it's the Argentine weather as we see the beans firm probably get a lift in the corn as well, because our demand is fabulous. As of today, record first early crop sales from September 1 through, which is the start of our crop year, through December 31st. We've never sold so much corn. And many are saying it's all front loaded. And maybe possibly it is. But the reality check is it's not all front loading. It is, we're getting the corn market because the corn leaving Ukraine is dismal. Never mind they had a drought. Never mind they are in a war. It's they have very little electricity throughout the country to auger the grain. Yes, the terminals have generators, but a lot of the farmers don't have generators to load the grain out of the grain bins with an auger. They got to shovel it out. And so that's why we're selling so much corn. So we anticipate corn to soon turn higher here. We do think this 34 range will likely hold on any further weakness in here if it does occur. Kansas City wheat, we mentioned last time we visited in the video, 2 days above the 200-day moving average. Kansas City wheat just can't seem to get two closes above the 200-day moving average, two closes above the 200-day moving average, two closes, can't do it. And we said it's likely going to be a big challenge. You get three closes, something's going on. Nope, sell it, it's going to take it back down again. Back to the 50-day moving average, which is the green line on the continuation. This is the 200-day on the continuation. Obviously, it'll be tied to corn. Any lift in corn will help support the wheat market again as well. By the way, we have a 60-day cycle coming in here. That lands, well, basically it starts already tomorrow because you got the 31st is 2 days prior to the 5th. You got the 2nd is on Friday. So the window opens tomorrow through early next week for a 60-day cycle low and turn this market up. The 60-day cycles have really been not as accurate as they were the prior years. You could almost live by them, it seemed like. But here you get a turn. Here you get a turn, but nothing that lasts. Here you get a turn. It's not like in the old days. You had a turn here, you had a turn here, you had a turn here. That 60-day cycle was phenomenal. So right now we're getting kind of ground up with all the world things that are going on right now. We're going to cattle right now, but I first started with a chart that you don't recognize because I don't have the label across the top. It is the February live cattle, and it is the daily chart. This pink line, normally people would use a 100-day moving average. Well, I use a 97-day because I like the things to fit and touch. This is a 97-day moving average on the February cattle contract. Amazing how it stops it. Now we come over here on the live cattle continuation, which is February. 62% of the whole collapse that occurred from the October high. Now the February contract is on the continuation chart, struggles here at the 62%, 231.5, keep stopping it. That's why I'm saying 32, a close above 232, probably gets us something further here into the box, so to speak. The box is their 78% retracement, 62% retracement. Everything in between is the box, meaning it's a wonderland. Anything can justify a stop. But we think we're in a wave A higher here, wave B setback, which cattle are notorious for seeing in January. If we don't have adverse weather, your holiday demand softens up, your box beef prices soften because all the Christmas parties that are happening, New Year's party corporates, they're wrapping up now. I'm going for a big beef dinner New Year's Eve, likely prime rib, one of those major Brazilian steakhouses. So I'm going to be handling everything, filet mignon, ribeye, the works. But nonetheless, the demand will start to falter. And that's why we typically seasonally see something break in January. There could be a wee wave, and this could be the April contract, maybe later on into the second quarter. On feeder cattle, this is the March contract on here, just holding the 15-day moving average every day. I'm targeting the gap getting plugged, attacking the 62% retracement, possibly near 351 for an A wave. If this occurs into the opening week of January, notorious to get a high, and feeders usually soften, especially into that January 31st inventory data report that comes at the end of the month, could give us some kind of a softening effect in here. And then could be a wave C into that second quarter, April, May feeder cattle turnout time. Could be our ultimate that I've been looking for, a left shoulder, head, and a right shoulder on the charts if we haven't opened the Mexican border sooner than then. Finally, we got to take a look at the crude oil chart. Still trying to rally there is no peace agreement. We constantly see Ukraine attack Russian oil infrastructure. So that's causing us to probably press to the $60 mark before turning back lower again into the new year. Same thing with diesel fuel. I talked about back when this spiked up here, I said these are usually spikes for diesel fuel. I said look for diesel fuel to go back to the 220 range, 210. That's what it did. I said if you have tax purpose buying, buy your diesel fuel for tax purposes, but We think we're going to be lower yet into the new year, and we'll make recommendations for further fuel buying for your finishing up your spring and summer needs. Probably something down in the 190 or even lower price range we can get diesel bought. This is Eugene Grainer with Heartland Investor Capital Management. Hope you find this information useful, and Happy New Year.